Hi everybody, my name is Craig Pritchard. I work for Integrity 365 and I'm a workplace pension specialist. So today I really just want to go over 3 areas you should be giving some consideration to try to maximise what you're going to receive from your pension in retirement. So the first area is taking advantage of technology to have a better way of engaging with your pension. It's fair to say the pension industry hasn't done itself any real justice when it comes to the annual statements that are delivered in the post to us each year. They have improved, but they are full of jargon and maybe not as easy to understand as they could be. So for me, technology is a much better way to engage with your pension, whether that's online, a mobile app. These are the kind of tools that are available via most workplace pension providers and give you an easier way to understand your pension, to log on and maybe visually see what your pension provision is both now and in the future. Now, these tools also enable you to really kind of manage your pension. So, a very important area which is often overlooked is completing your nomination of beneficiary form for your pension. So this is where you express who you'd like to receive your pension if you were to pass away. Very important that you do that at outset, but also keep up to date if your circumstances change. You can also update your personal details, such as your address and such like, but you can also get projections of what your pension may be worth in retirement. So projection of retirement benefits. Some providers allow you to do what I call a what if scenario. So what would I get if I put more into my pension, retire at earlier or later date? So you can always play your pension, see visually what impact that has on your projected pension funds and therefore the income at retirement. Another area is maybe reviewing or changing the investment funds. Most people go into the default fund with their provider, their employer pension scheme. For some people, that's absolutely fine. For other people, they want to have maybe more sophistication, slightly different investment approach, and therefore, changing your investments online is an opportunity that you can undertake if you do want to have a bit more hands-on investment experience. If you do nothing else, try to register online with your pension provider, have a look at what it's worth, what it's going to give you, and hopefully, if nothing else, it keeps you informed, very easily via an app, etc., in terms of what's been paid in, what it's going to give you in retirement, and hopefully just gives you a bit of an insight into where you are. So the second area is what I call the pension jigsaw. If we sit down and think about our retirement, there will be different ways we save. So it could be through pensions, and that won't be just maybe the workplace pension scheme you're in now, but maybe other pensions you've accumulated from different employments. You may have other savings, other investments, whether that's ISAs, property, stocks and shares, etc., that you're going to use towards your retirement as well. But it's very difficult to look at each of these pensions or savings in isolation and get a true picture in terms of what our retirement provision will be. So really, to understand what retirement may look like for you from a financial perspective, you need to have that complete picture. So that's really where you bring all the different pieces of the jigsaw together to get that true picture. Now, that doesn't mean you have to transfer and move all your pensions into one. That's something you may want to do, and that's maybe a conversation for another day. But it's just understanding the value of each pension to see, okay, what's the pot worth now? What's it going to be at your respective retirement age? And it just helps you then formulate that picture as to whether you have enough income or whether you need to look to put more into your pension. Now, people often say to me, Craig, what should I be looking to save for retirement? And that is subjective. It is dependent on everyone's own individual circumstances. But the Pensions and Lifetime Savings Association issue a retirement living standards report each year. And they basically categorize it in terms of a minimum standard of living, a moderate and a comfortable lifestyle. So for example, if you're looking for a moderate lifestyle for a single person, the research identifies that you need an annual income of around £23,300. And if you're a couple, that's about £34,000. So that will give you a bit of a feeling as to whether that's the level of income you need. And you can look at the assumptions in terms of assumptions around holidays, your weekly shopping, etc., in terms of whether you feel that would be right for you. And then when you have that information, you can look at those projections, look at that jigsaw of your own retirement provision and look at if you're on track. And if you are, fantastic. If you're not, now's the time to kind of address that. And then the final area is now the time to increase your payments. Very few of us pay enough into our pensions. And we're potentially missing out on some unused kind of tax reliefs, etc., which would help boost what we have in our pension plans. So what are the benefits of paying into a pension? Well, firstly, if you're an employer's pension scheme, your employer pays into it. So the company will make a contribution, which is typically at least 3% of your salary, but it could be more. And some schemes do offer a kind of matching or enhanced scheme basis. So always take advantage of any enhanced employer contributions if you're able to do so. Secondly, we get income tax relief when we pay into a pension. So depending on whether you're a basic or a higher rate taxpayer, you get 20, 40, or maybe 45% income tax relief on every personal payment you make. We don't get that on any other savings vehicle in the UK. So that's almost at least a 20% boost on every payment every month, which is fantastic. Some employers offer salary sacrifice or salary exchange, which again is a more tax efficient way of you paying into the pension because you benefit from savings in national insurance on the value of your personal contribution. So again, explore with your employer scheme whether that is a facility that's available for you. Also, you can use pensions from a tax efficiency perspective because as you know, you may cross into the higher rate or 40% income tax band, and by paying into a pension, you can actually reduce your income back below that threshold if you want to save some tax. Likewise, when you earn over 50k, you start to lose child benefit provision if that's applicable to you. So again, by paying into a pension, that can help you maybe retain, you and your family retain that child benefit whilst boosting your pension funds. And the final area is for people that earn in excess of £100,000 a year. Hopefully you're aware that your personal allowance tapers down on a kind of 1-for-2 basis when you earn above £100,000. So again, if possible, you could potentially pay into a pension to reduce your income or keep your income below 100,000, and that will mean you'll retain your personal allowance, which is clearly a tax efficient thing to do. And the final area is around investment markets. Those of you that have looked at in pensions or investments over the last 12, 18 months will know it's been a really volatile kind of 18 months, 2 years. And that generally means that the value of our pension funds have maybe fallen, maybe come back a little bit, and maybe fallen again. But the benefit of paying into your pension on a monthly basis is that you do buy units or shares in those investment funds at a discount. So actually, if the markets are falling, it's cheaper to buy those units. And hopefully over the longer term, those funds come back, and that means you make a return on your investment. So actually, now could be a good time to be putting more into your pension because effectively you're buying your units or shares on a sale price. If we were buying any other commodity or service or good, if we can get it a little bit cheaper, we generally want to do that. And the same applies with our investments. So for me, it's really important to try to review your payments and ideally look to increase your contributions. Just a little bit now and again will help. So maybe every 1 or 2 years, maybe when you get a pay rise, direct part of that into your pension, part into your take-home pay, and then you'll see a gradual increase in what you put into your pension, but also an increasing fund value, hopefully over the long term. If you've got any kind of pension questions, I'm more than happy to help. I just encourage you to get under the bonnet of your pension, just thinking about it a little bit more. And if you need anything from me, please do feel free to drop me an email. Thank you.